Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, March 21st, 2024. It is 1:36 p.m. Eastern Time as I'm starting the video here, and here's what we'll cover. I want to look at a handful of indicators and also talk on, of course, what's going on in the markets, post-FOMC noise, and at the end I'll try to address there are a couple snide comments on that whole what I call FOMC noise. And guys, do your own thing. My job is to post analysis, objective entries, trade setups, and you decide what to take. But we're going to go over some of that in this video and some of the recent trade ideas as well. But we're doing something, I don't do this daily, but from I don't think a month goes by that I don't at least go over the various breadth indicators and what's going on there to try to ascertain if a correction or a rally is likely to continue, if it's healthy. And so we'll get to that in 1 second. I just want to throw this out first, put it in the beginning of the video. I did post a setup for you under the comment of the post I got out to you this morning. And basically, it kind of dovetails on that post I got out to you. I put a little purple box. We're back to the top of the trading range. Remember, yesterday pre-Fed, I got out to you. If you wanted to, try to thread the needle, it was right in front of the Fed, and we had that little divergent high there. And I talked about this trading range we've been in now for the past all month. You can see this chart goes back to the beginning of March. And that's it. And I gave you yesterday, I told you it was a 3.7% range. And that's where we pretty much started the day. And you can see, so there's your setup. It was a divergent high, the latest on this 15-minute chart, overbought as well. You can see I have an extreme overbought reading here at about 86 on the RSI. And that's typically, there's no, these momentum indicators, at least the RSI is an oscillator. It's range bound between 0 and 100, but you never get to 0 and you never get to 100. You get pretty much to about right here, 86, and that's usually about it before you at least get a pullback. So mountain evidence, even though we're still in that what I call a post FOMC wake or noise period until tomorrow, maybe early next week. There it is. Take it or leave it. And again, I added notes, and my God, if I don't say the same thing over and over and over recently, but then you read some of these comments as if I don't, and I'll get to that. We're still, since yesterday, just to summarize it, again, because when I read the comments, we didn't get the sell signal. We need to take out 433, the yellow level on QQQ, the bottom of the range that we've been in for the last couple of weeks, and we didn't. And before the FOMC, I said, if we go up, that's not going to change anything from a technical perspective. The only thing that could have changed yesterday or today from a technical perspective would be a break of support. There's no really resistance overhead. We've been grinding in a range. We're at the top of that range now. And there was zero probability of taking out the divergences based on where we were on those. And if you went up a little more, then you're only more overbought, like I just showed you. We went from overbought yesterday to extreme overbought on that 15-minute chart I showed you, where, nearly every point in time, that's it, at least for the near term. So again, nothing's changed on the daily time frame from a bigger picture. On the short-term time frame, the only thing that changed between now and yesterday is we rallied up to the top of the zone. And as I said in this, the little setup here, there's two ways to make an objective entry on a long or a short trade. On a short trade, I said that while I would prefer to see a well-defined uptrend line in which to trigger a sell signal, well, that's one way. When you break support, the other objective short entry is a rally into resistance. So that's it. There's again, so if you are looking to go short, you want to either rally into resistance, if this is a resistance level and with a stop somewhat above, or if you're going down, you wait for a break of support. Likewise, if you're long and bullish, you wait for stocks trading and you don't short into resistance. You either wait for a breakout above resistance, or let's say you're in a price channel like have been recently, you wait for a pullback to support. Those are, to keep it very simple. Now there's other kind of candlestick reversal patterns, tops and bottoms, and other plays, but that's in the most simplistic view. And this is a grind. Trading, if you do it for a living, it's a grind. You just take your shots. You know, like to say you miss 100% of the shots not taken, and you line up the odds, the probabilities. That's it. So, and at the end of the day, if you don't like it, don't take it. Like I said, if it's not, you know, it's still, like I said in the very beginning, should be considered an aggressive counter trend trade, i.e., not a high probability trade. And that's going to be, again, the break of QQQ 434 support. So let's dive into the charts. We'll roll into the indicators. There it is. So there's 433. We last tested it the day before the Fed on Tuesday. Went up, little minor downtrend line right there, but I'm just going to leave it out. And that's it. We're at the top of the trading range. You can see almost right about, if I turn off everything here, we're pretty much back to that high. So this is it. This is your trading range, and I don't know. There's not much else to say about it. As I mentioned a minute ago now, breakout above resistance is typically bullish, and in trading, I have to decide, or you have to decide as a trader, which breakouts you're going to buy or which ones you're going to short if it's a break to the downside, and that's based on the failure rate. So I talk about that quite often. Said this probably 1,000 times or more over the years, that breakouts that occur on a marginal new high, with breakouts that occur to new highs or any upside break that have negative divergence, which, as I said in the post today, or in that comment section, one of the two, we have negative divergence now on every time frame from that 15-minute I just showed you a second ago and posted earlier in the comment section, all the way out, including this is the daily right there, clear divergence, 60-minute. And I know, guys, I see the comments, oh, another divergent. Here's the thing to divergences. And if I've said this once, I've said it probably 10,000 times over the year. Positive divergence is not a buy signal. Negative divergence is not a sell signal. It's an indication, a likely trend reversal. It increases chance that you're going to get a trend reversal. And then the timing will come once you get the sell signal, then that's an actionable trade. Now, we did have, we'll say we had a couple, one, two, we've had a few objective short entries. We had that one was the pre-NVIDIA. Like I said, take it with a grain of salt. We had a couple breakdowns there, especially to break the primary trend line, then the back test, and SPY, as I showed you earlier, we're back testing as well. So, and all of those are what I, consider lower probability of counter trend trades. There's a SPY making a back test of the wedge, the primary uptrend line. But until, again, you take out the yellow lines, particularly QQQ 433, and then the vast majority of what's left of the MAG, formerly known as MAG 7 stocks. I'll try to get to them in a second, but let's do this instead. Let's get to some of the indicators, and I'll share my thoughts there. Okay, and this is very important too. Towards the end of the video, if I can keep this, limited in time, 30 minutes, give or take, I will speak to the comments that have been made, about the divergence and this big drop that I've been looking for and in the markets. But then again, speak to the fact over and over, what's actionable, where, I'm trading and put a lot of trade ideas out, long and short this year, including the indexes. Coming into the year short, covering right at the lows, posting clearly closing all shorts, going long. And so we're up, I think, 12% year to date on the NASDAQ. And we were actually long at the lows after covering the short that we had at the end of December with biggest drop in months. So I say that because it is frustrating. I see the same handful of folks making the same comments, but, I talk the bigger picture and then what needs to happen to get there, most importantly. So it is what I think is going to happen, what's the most likely scenario, but when do the odds increase sharply on that? That's when, again, we get those collective sell signals I'm looking for. First, we have those yellow lines on the MAG 7, or formerly known MAG 7, the sectors as well, the top sectors of the S&P, and of course the indexes themselves. Then we have the same purple lines last year that were the most important, that it will, the yellow lines are going to sharply increase the odds of the next tradable swing or trend tradable correction. That's what I've been talking about. 10% or more, let's call it. or in the 10% range, 8, 10. I'll give you, I already gave you some targets the other day. Then those purple lines, again, I'll have to jump back to that later. Those, if taken out, those are the same purple lines I was highlighting back in last fall, and the same purple lines that I stated going bullish, closing all shorts, and going long at the end, last fall, just before the NASDAQ and the S&P had their next leg up, because those, not only because those levels held, we were at those supports, but 200 days, divergences, everything else. So again, nobody here, at least not me, has been saying be short the market all last year. We had several I'm giving you my long-term scenario where I think it's going. I still believe in. That's what I'm going to do in this video. So you'll take this analysis, do what you want with it. But the analogy I'll use, our dog, right now, we took the dog to the vet. Was it earlier this week? Oh, no, Friday, over the weekend. Anyways, dog started limping. Dog's got a bunch of energy, and my wife noticed a lump on the chest, and so the doctor, we scheduled the vet, said you need to see the oncologist. Oncologist scheduled a CAT scan, CT scan, and did biopsy. CT scan lit up a bunch of spots throughout the dog, and he sat down with us, said, "Look, I suspect it's sarcoma. I'm pretty sure it is. Dog's probably got a couple months, maybe 3 months at most. It's going to start going downhill quickly, but it may not be. It could be, he said at a smaller probability. Could be you can put him on an antiparasitic. Sometimes you see these parasitic infections that'll light up his spots." He said he took some biopsies in 3 of the tumors or suspected tumors. But the thing is, we'll get the results tomorrow, later today or tomorrow. And at that point, if the biopsy comes back and confirms definitively that it's the sarcoma that he thinks it is, then guess what? Then the odds are very high. He can say with a high degree of confidence, okay, your dog's going to start going downhill and be gone soon, and you need to start hospice for it. Or comes back and says, guess what? They sometimes things walk like a duck, quack like a duck, and probably is a duck, but maybe not. So the takeaway there, guys, until you get the evidence, the breakdowns, the sell signals, the breaks of support, and then when those purple lines go, remember that if and when that happens, we're going to drop back below the 200-day moving average, and I'm going to start talking long-term indicators again. I'm going to go focus a little more on the weekly charts and the longer-term charts, even the monthly charts. So all I'm trying to say is, like the vet suspects one thing, can tell me with a pretty good degree of confidence that's going to happen, but it's not definitive, or the odds will go up very sharply when the results come back. So hopefully that analogy, I know I'm always trying to pull these analogies out, makes sense. And because when I say it, I might speak this long-term bearish talk, but then at the end of the day, as we've seen, and I'll go over towards the end, been long the Qs multiple. I mean, literally, if you count the day trading account, the active trading account, probably, dozens of longs this year. But even swing longs, I just want to make that very clear coming into the beginning of the year. Let's go over those indicators, and we'll get to the long-term charts. And I'm going to talk on a couple other things, gold, silver, and all that stuff, because I had questions. Bitcoin had some questions yesterday. So this one is this is a popularly followed indicator. And in the past, you've probably heard me say, I've always shared this one. That's the AAII Bull Bear Spread. That's the American Association of Individual Investors. They do a weekly survey to gauge if people are bullish or bearish on the market. And it's a contrary indicator. The more people are bullish, then typically that's a bearish sign for the market. You might say, well, why? How does that work, Randy? Well, let's just say hypothetically, if everybody's bullish on the market and the last bull has just bought they just deployed their last dollar, his or her last dollar into the market, or Apple or Nvidia, there's no one else left to buy, and that's when stocks tend to go down. And you can see it very clearly. And for years, I haven't even modified these levels. I've had a red line that typically does the trick. You can see when you spike up to the red line there, that's usually precedes a top. You can see the red things here, and it doesn't look like much down below, guys. This is the S&P 500, the stock market, because I'm using log scaling. So that little blip down here, 2007 to 2009, was a 56% bear market, one of the worst in history. COVID was 36%, or before you know it. And this is what we had in 2022. Okay, so just wanted to point out last time, and I did cover it more recently, that was towards the end of the year. We had the biggest drop since the market bottomed back in October, and that was foreshadowed by a perfect tag. Again, at this level, these lines have not been altered or changed. I've had them here for years. Hit it, highlight it, and then boom, that was a double-digit tradable, swing tradable trend. Came down. My buy zone runs right here, the green line. We came pretty much to the top, a hair above that, and that marked that low. And I just wanted to point out, here we are again. And this is not a one and done. Sometimes you get a one and done, but quite often it's these clusters or persistent high readings above that range before it takes that extreme bullishness for an extended period of time before the correction sets in. So do what you want with it. My job again is to analyze and give you these the facts out there. So it shows that the vast majority of market participants are bullish. That concurs. Somebody was so kind to post the analyst forecast for 2024, which is almost a joke. It's well-known Wall Street analysts are extremely bullish. And guys, guess what? Most of the time the stock market goes up. So it's kind of like the weather forecaster that called for rain. If you remember back in Burning Man, for those of you not familiar, Burning Man's this huge festival out in the middle of the Nevada desert, in the middle of nowhere. People come from around the world, big, like Woodstock type thing, but modern day music festival, all that good stuff. And, the weather forecasters were calling for not just rain, but torrential rains in the middle of the desert. Well, of course, all the fun-loving participant, they didn't agree, and they went there and they warned them. Guess what? When it rains in that part of the desert, the mud becomes like quicksand. You can't even move. And anyway, you can Google it and read it. And people got trapped. Somebody even died from the event. A lot of people were seriously ill or injured or stuck, for days. And so that's the point. Is it doesn't happen often, but when the indicators line up, and if it says it's gonna not just rain but dump hard on the desert, you got to heed those warnings. Now here's the thing. I'm all into weather. I'm a big boater, and so I follow the weather forecast, especially when I'm going offshore, 50, 70 miles. I need to know what the weather is. I don't want to be caught out there and meet my end. So sometimes they give you a high chance that something's going to happen, and it doesn't. And that's all. So I probably spent enough time talking about that. So there's a difference of forecasting where things are probably very likely going, and nothing's changed in my view. And here's why, because I'm hearing the same song being sung by so many, even those folks on TV. Oh, market breadth is improving now. The forecasts are being raised, everything else. I'm just showing you what I follow here. So there's this AAII survey. Again, it's the ratio or the spread between bullish and bearish market participants. And it's certainly been at extremes that have preceded everything from the Great Recession. Let's see, COVID was kind of a one-offer, but these were the bigger drops in between there. I got a few more for you. Let me pause the video and cue them up, and we'll move on. Okay, so that one was sentiment, and this is market breadth, because I've been seeing more and more comments lately about how, and there was a little a spike improvement recently in internals, but it was a brief, I'm called aberration. It was a fleeting improvement in internals. I've used this chart for many years, decades actually, and find it to be one of the very reliable. And again, it shows conditions. And I have to say these things 100 times over. Conditions such as overbought, oversold, divergences, because those things are conditions that continue to build. Typically, not always, but typically, the longer they build, the bigger the ensuing trend change. So what you're looking at here is the NASDAQ 100 up top, and on the bottom is the NAAD. That's the NASDAQ Advanced Declining Issues line. All right, and you use a cumulative if you're using this is on stock chart. And so it shows leading up to, again, this was the Great Recession. That was a 55+% drop in both the NASDAQ and S&P, preceded clearly by breadth deterioration, particularly in the NASDAQ. The NASDAQ is everything now, even though it's not the most diversified of indexes, certainly not. It is the most important. It has the same heavy weighting of tech stocks, but at a bigger component than in the S&P 500. And the S&P 500 would almost mirror this if you put it down below. So There it was. And what you can see here, this one, we're on a daily. I've got a weekly for you too to show you. You don't get them often. So what you're looking at here, just so you know, you see my divergences. And I know from the comment on the sites, oh, these divergences. Okay, well, when you have a rally, when the market bottoms, that's what you want to look for. You want to see the NAAD, the advancing and declining issue line going up. That confirms a rally is healthy and has a lot more life. But at some point during that healthy advance, when you start to diverge, when the NASDAQ up top is still going up, but then the NAAD is falling, that warns of these corrections. Those were double digits, many months. You can see the scaling down here. That was about a 6-month double-digit correction. And again, everything was healthy from here, and you started to diverge. This was called a deer market. And a deer market is neither a bull nor bear. We went for almost 2 years, well over a year and a half, sideways with two roughly 20% drops in between right there. And so you would either wanted to be short or out the market at that point. And again, it was a very, very accurate predictor of it. It's not a timing indicator, just like negative divergence, just like overbought conditions or oversold or positive divergence. It is a condition. And then that condition, when met or confirmed, just like, waiting to get, lab results back on a biopsy, then you know what you're dealing with. You can suspect, doctor gave me probabilities, or the vet gave probabilities on what it might be and what these other things could be. But then the probability goes to, basically 100% if pathology confirms. And same thing with these cell signals. If you get them, then now you have your timing indicator. Otherwise, this divergence right here, there's, by the way, COVID, call it random if you want. Many indicators were warning a big drop was coming in the market, such as this one, negative divergence leading up to the COVID highs, and negative divergence right there. That was the 2020, late 2021, early 2022 highs in the market, foreshadowed by negative divergence. And this is what I wanted to share. I spent a lot of time doing this, and this is why I don't, my longer term outlook hasn't changed, because the indicators that I've used for years and have proven very reliable are saying that, hey, the market's going. We know this. We know it's just now fewer and fewer stocks. Apple has left the Mag 7. Tesla long since left the Mag 7. Apple I want to get to in a second. It's I know the DOJ just wants that case against it today, which I've always figured would be the final death blow to Apple if they ever break their iMessages and all their closed ecosystem app. That's what they're talking about doing. You can read up on it, but again, it doesn't matter why. Apple's been going down in advance. Something's clearly broken that stock. All right, guys, that's it. So there you see. How could my longer term outlook? How could I have the same outlook as the analysts right now with a rosy year-end big gains with this? And this just confirms what I've been looking for a long time, that these divergences, which is breadth deterioration, again, many more issues declining than advancing, and that will manifest in the form of correction, as it always has historically. These are not just obscure kind of weird indicators that I've found to fit my, longer term guess on where the market's going, or whatever you want to call it, bias. These are tried and true indicators. I'm not the only one that uses them, but you don't usually see these on CNBC. Let's see, I have another one here. This one is the NASDAQ new high to new low ratio. So as the name implies, it's the ratio of stocks making new highs and new lows. I didn't put it in log scaling down here, so it screws this up. Remember, that's a 55, 6 plus 7% drop there. It makes it look a lot bigger here because when I did this chart, I forgot to put in the comma at LOG on the bottom of the comparison. If you use stock charts, that's what you need to do right there. Put a comma. Either way, they were all big, if not double digits, very near double digits, including 36%, 37, I think it was there. And here it is. Again, I'm not trying to make these fit what I see. I saw negative divergence leading up to the great financial crisis, one of the most profitable bear markets in generations to trade, and one of the most profitable to sidestep and put your 401k into cash if you heeded the warnings and you don't short. look at it there. Again, they don't look big, but they were double-digit drops. Divergence, and they're rare. Here's the thing, guys. We're looking back. We're going, what is this, 20, almost 20? Yeah, it is 20 years. Divergence right there. That was the big Q4 2018 drop. We milked that perfectly down to the bottom, went long off the lows for the reasons I anticipated, which was the Fed pivoting. That's when the Fed first tried to take the easy money away from the markets, and they threw a hissy fit. As predicted, the Fed gave this spoiled brat what it want market when it started crying. Led you up to COVID, boom. But again, COVID was foreshadowed by another divergent high. 2020, this big bear market in 2022, or what I still consider an initial leg down, clearly foreshadowed by the negative divergence. And here it is now. So guys, we can go through them all. This is just the bulk of the ones I have here. Let me go to another one. Let's look at the McClellan oscillator, McClellan summation index, NASDAQ. And I am focusing on the NASDAQ here, of course. That's the, to me, the all-important index. Looks like I cut off to the left of the, there's the bear market back then, 2007 to 2009. It had the divergence leading up. I just cut off on this. I didn't go back. I'm only going back 16 years, but it was there. Divergence. And I measured the drops for you here, by the way, off all these divergent highs. I'm just going to read them out to you. 55+%, 18, 20, 20, I'm rounding off, 26, 31, 38. And that is after each and every one of these divergent highs. I think there was dotted lines there. I wonder why I did that. And that's it. So that is the state of the markets right now. This right here. Now look, if we do this, guess what? Well, it's certainly taking away this one piece of evidence that points to, again, in the next, points to a trend change, and a trend change that has historically been measured in double digits. And so if that gets taken away, and these other ones that I'm talking about, whether it's 3 months from now or 6, 8 months from now, then guess what? It's going to be hard to sit here and make the same case I've been making. But, these things take time. These divergences leading up to the 2000 lows. I'm sorry, not the 2000, the 2007 top. They took about this long to build, you can see. And that's the thing. Look how long that gives you a measure in time. If you go from, the left edge to the right edge, this one took quite a bit. But the 2007 top had almost identical divergence. So that's one. Just a couple more and we'll wrap. I showed you the NAAD, but I also have a weekly. Let's see, that's right about here. This one shows you the same thing, except it's set on a weekly. So it gives you the weekly print, and it's the same thing. And it spans back all the way. There's a dot-com bubble, guys. There's 2000. Remember that? Some of you are obviously too young to remember. Others will. We had a runaway market, and the NASDAQ dropped by almost 80% following that. 78, I believe the number was. And it was clearly foreshadowed by this negative breadth, this divergence between the NAAD on a weekly basis and that. Again, we had healthy advance. You can see my arrows. Green arrow, the NAD was going up when the market bottomed. That told you, hey guys, you're in a new bull market, buy stocks. Then you started to diverge, and you diverged all the way up to the market top in October of 2007, followed by a 55+% bear market. And then each and every one, again, coming out of those bear markets, it was healthy. The market breadth was healthy. It's what you want to see. More stocks going up than going down. And what we've seen recently, and most importantly, what we're seeing right now, is clear divergence. There's that little brief uptick that I talked about, but that's stalled out. And especially when you look at this, you want to compare it to the rate of ascent, and you can see this, relative. Again, it's a long-term chart. It's a relative surge, almost a blow-off top type, just like you had right here with that divergence. So there it is. There's another one, and I'm only going to show you 2 more, but I really like these. It's kind of like, your kids, if you have more than one pet, and you can't pick a favorite. I love them all, but they're all important, guys. In all seriousness, these, I believe, are very important indicators. And again, I'm going to say it for those of you who you know who you are. These are not timing indicators. These are formulating my big picture. These aren't, oh, when you start seeing the divergence, start shorting the hell out of the market or sell everything at a 401k. Nope. All right, so this one, I love it. It's the NAA 200R. That is the NASDAQ percent of stocks trading above their 200-day moving average. It's very simple to track. There's two things on here that stand out to me. This line, I've shared this one before. This is where bear markets end, when they come down to this level, or at least every bear market in decades now, right? Which wasn't many. We had, technically speaking, all the textbooks agree, or whatever media. 2000 and the bottom in 09 was really the NASDAQ bottom in October or November, but everything else was March 09. But either way, no one will argue that was the great financial, great recession, financial crisis, and then COVID. You can't argue it was over before you knew it, but it was 36% in the S&P. So I think by just about every metric, the technical definition of bear market is a drop of 20% off the highs. So there it is, and that's where bear market ends. This is where corrections end. Here, here, here. These were just bull market corrections along the way. And that's where we bottomed in October of 08. And, or this bottom just before that. And you can see, in fact, not only did it bottom just before that, but there was positive divergence. The number of stocks trading above their 200-day moving average was making a higher low, with the markets making a lower low. So, but again, the takeaway is, look, I took, in college, I took statistics, and I understand as a statistician, you're going to say, well, there's a relatively small number of data points here. So I'll go with that. So it's not definitive, but you can see it's pretty, by every other metric I use, and I've heard others say this, there was zero signs of a traditional bottom back in October of 2022. Nothing. The whole selling climax, capitulation, there wasn't a whole lot out there, including this, and it pretty much formulates what I believe and believed it would be all along, a very long, drawn out, different bear market than anybody's talking about now, or very few. At the end of more of an end of a secular bull and beginning of a new secular bear market that's going to have the drops and the rallies are going to be their own little cyclical bull markets within. And the whole new highs thing, I'm going to get to that in a second, because that's what I hear. Oh, the NASDAQ just made a new high or whatever. I'll get to that. We're basically at a double top. And the thing is, most stocks still haven't made a new high. Let me prove that to you in this next one. All right, so that was the percent of stocks trading above their 200-day moving average, right? And I've also got it here just so you can see stocks trading above their 50-day moving average. And again, you can see all the divergences. I won't have to spell them out. 54% drop. I'm just going to read the drops that when we got the divergence. So it's healthy when you see more and more stocks trading above their 50. But what happens is when you start making lower highs on that indicator against prices making higher highs, that's negative divergence. It's the same type of negative divergence I use on the price oscillators, momentum indicators, PPO, RSI, all that good stuff. And without fail, 54, 20, or 19, I'm sorry, 18%, 16, 18, 19, 24, 30, 37, and put a big question mark here. Because unless this goes up here, and we already have the divergence, and these divergences usually play out. Why? Because they show you there is a trend underneath the hood that many are just dismissive of or don't recognize, and that is, fewer and fewer stocks are going up. Not only that, you can see right here, here, let me go to the next board. It'll show you this. I'm going to go to one that has both the 200 and the 50 days on it. I really like this one. So here's again, the NASDAQ, or this is QQQ, same thing. The NASDAQ 100 up top. Right here, this one here, you've got the percentage of stocks trading above their 50-day moving average, what I was just showing you. And then the chart before that, I was showing you the percent above their 200. So there's two more takeaways in this chart. The divergences obviously are going to be the same. I already showed that to you there. And I want to point out there was a divergent high, negative divergence, and we got a 13% drop. Okay, so it's not as if it didn't pan out. Now, what happens is sometimes you're done. Here's a good example. We had a divergent high back there just on the 50. and you got a correction, but then it got bigger, and then you got a second correction that lasted longer. And right now, what you have here is this is the same divergence, just larger. So again, you've got the first, call it shot across the bow, went up, made a new high, and you can see when you did that, it's really starting to drop off right now. So this was that little thrust I just talked about. And I recognized earlier in the year QQQE and SP, and they talked about, I heard a couple bobbleheads talking about it, and we saw it, but it was brief, it was fleeting, and not only did it stop, but it's gone the other way now. There's a marked drop off, if you can see here, in the percent of stocks trading. And remember, the 50's faster. So this tells me under the hood right now, there's a lot of selling in the market. You don't see it. Why? Because NVIDIA keeps going up. And NVIDIA has such a large weighting, and most of the things are going up. But again, do what you want with it. Look at the stats. And nothing is guaranteed, but there's a lot of evidence pointing to this. And so if and when we get those high probability sell signals I'm looking for, I'm not going to be looking for 6, 7, 8% quick. I'm going to be looking for a double digit plus correction, and quite possibly the next leg down. And look, and if these change, and the other thing I wanted to show you on there is right now, okay, so I heard a couple, certainly some cheerleaders on TV, and there were a few on the board on the comment section about S&P or whatever making a new high. Okay, guys, I will say this is an end-of-day chart. I believe, I'm almost certain this is an indicator, meaning it shows through yesterday, but yet we're not up much more. The NASDAQ is only up like 0.5% or so right now. So you have, right now, or as of yesterday, both the percentage of stocks trading above their 50 and their 200-day is below 50%. That's significant. Number one, it tells you, again, how is the stock market at new highs if more than half of the stocks in there aren't even trading above their 50? That tells you they're certainly now nowhere near to their new highs. And more importantly, if you look at this, especially down below, this is the 200-day. You can see the bigger trends. Let me just try this way. I'll box in 31% drop, 24. We know that was a bear drop there. A flash crash right there. Look at where you had these periods, 27%. Remember, QQQ was 27. It was because it's an ETF. I remember back then there was a flash crash in the market in 2015. The NASDAQ composite didn't go down as much, but because an ETF can be subject to that, it did. 18, 12. But what you're looking at here, this is kind of a larger, bigger picture trend indicator. This is when you need to be careful about getting too bullish. This is when, quite often, and I didn't go all the way back in this chart, but that's what you would have saw back then, is bear market rallies take you back there, and that's what we did here. So we can see here, we get to this line, it's been resistance. This is, you're bullish when above it and bearish when below it. Now, I know it's been a nice run, but there's been some corrections along the way, and here's another one to watch for, guys. If this does this from here, that's going to be bearish and most likely coincide with the next leg down. If you break out and you start having the majority of stocks trading above their 50-day and especially their 200-day moving averages, well, it becomes a lot harder to make a case that you're not in a bull market, especially, or one with more room to run. And then, of course, if you take out the divergences, which all you have to do is start taking out the previous highs, then again it gets a little harder. So there it is. To me, that's a lot of pretty clear, solid evidence with pretty strong track records. And, just like the analogy I used earlier, you can't say definitively until you have, enough evidence. I mean, the only way you're going to definitively say we're in a bear market is once it's dropped, 20% or more. And the problem with that is by the time they tell you, Kramer comes out and tells you you're in a bear market, sell your stocks, you've already lost, 30, 40%. So you got to try to get ahead of these things. And again, not too far ahead. We're waiting for some major sell signals. I told you, me personally, I already came into the Fed meeting with some initial starter positions on shorts that I'm waiting to add to and will not add to unless I get those, the other aforementioned sell signals. And if we start popping above these highs and going much more, I won't give them much more. I'll tell you, it'll be probably the beginning of next week. If I don't see what I like in the market, I'll just throw them away. And again, that's a swing account. Let me get to one other thing for you here. Okay. So earlier today, I made a comment and made a point to give you not every chart of all the FKA Mag 7s and every chart of the indexes. The one that I think is most important, like I said, they've already taken Apple out. They long since took Tesla out. We've got a few more holdouts in the Mag 5 and shrinking contingent. But to me, really, and I may be wrong, maybe overreading this, but it's all about just this one. They get to kill the, in the battle, you kill the general. It's pretty, maybe you won the battle. I don't know if I know that's not a saying, but that's the general right now is NVIDIA. Okay, so I said it earlier today, and Randy, that's your opinion, but this is a strong market. Microsoft, Meta's doing well. No, NVIDIA. It's all about NVIDIA. So I'm going to show you. So this is Google Trends. You type in, you can search any term you want to see. And I use Google Trends every now and then to, for stock market purposes. And so you can see the huge surge, this parabolic surge in NVIDIA. Now, here's what we're going to do. Apple was forever and a day let me just make sure I do the right one. I want to do Apple, make sure it's the stock, AAPL, NASDAQ, there we go. Forever and a day, Apple was the one, right? Was the largest component of the NASDAQ 100 pretty much since the financial crisis. It's been the best performance. It was the first $2 trillion, the first $1 trillion, if I'm not mistaken, then the first $2 trillion, then the first $3 trillion company. Right now, recently, since it kind of left that pack, the Microsoft leapfrogged it as in market cap recently. So we're going to put up those two in here, and I'll get to my point here. So we're comparing them here, and so you can see this. Nobody care. Okay, I'm speaking, guys, not literally, kind of figuratively here, but nobody cares about Microsoft and Apple anymore. This is indicative of a bubble. I'm going to get back to this chart. Just look at this. Oh, let me see. I'll zoom in for you. Hopefully you can see it. There's NVIDIA in blue. But I've got a couple more for you first. So, and I promise you I did not cherry pick these. I went to the two meme stocks that popped in my head from recent years. And of course, that for me, that's, GameStop and AMC. And so we go back. I've got it here for 5 years. This is GME, GameStop. You can go back as far as you want. It's a flat line. Nobody cared about it. There were no searches on it, relatively speaking, of course. And then, so let's check the date of this surge. This is January, the peak. If you see my little pop-up, I've got to get it right there. That's the week ending January 30th, 2021. Okay, and you see that huge spike in folks Google searching GameStop, researching, obviously buying it. How do I know that? Well, we just look at a chart again. Week ending January 2021. Let's throw up GME right here. That's right, that candle right there, January 29th. Okay, so if you think that's just mere coincidence, that mirrors. And it wasn't just a spike; it was a parabolic advance, and it marked the top. If you bought, as many did, because again, they're Googling, you could see the Google increase going up. That was the apes, they called themselves. Diamond hands, diamond fit, never let go of the stock. Hold it, we're going to break it. It's going to go to the moon. I remember price calls for $1,000, $2,000 from these, whatever. So if you bought it, you bought into that hype, like many did. You can see the volume. That's a buying climax. Massive volume means way more people bought up here than bought down here. And so if you bought into it and bought into that hype, and it's a clear, again, you're now down 90% since that peak. And again, you can do this yourself. That's available on Google Trends. Okay, the other one, and it's the only other one I checked. I didn't check anymore. AMC. Because AMC was recently in the news, and we've had some frothiness in the market. This was back in July, so peak. You can see And you can go back farther, but I promise it's just mostly flat lines. So I kind of zoomed in so you could see it. Week ending July 29th, 2023. A clear increase in interest and then surging right there. July 29th. So now I go to the chart. AMC. July 29th. Let me make sure I've got that right. Yep, 2023. Yep, 2023. And that's right here. So you can see right here. So interest was surging. The stock had already peaked because it was a meme stock. It peaked with GameStop back then. But you can see a lot of interest, and it was going up through that. They were buying into it. And when you can see that interest peaking right there at the end of July, from that point, the stock plunged and is already down 93%. Okay, so I wanted to give you a few examples because, I call this right side of the chart. I'm trying to predict what's going to happen, not what's, you look at what's happened in the past to predict what's going to happen in the future. And so I'm going to go back to that other one. And I already showed you a very clear and almost identical when you look at where the interest was coming up. And this is, again, NVIDIA. And to me, it's a bubble stock. AI is overhyped. Whether you want to put the term bubble or not, only in hindsight will we know. My guess is you're going to see very tepid demand from Google and Apple and everyone now jumping on that bandwagon, plowing in all their resources to these AI tools, which I told you I don't see it there. I don't think people are going to pony up. I think they're going to have to give them away free for years to come to try to get people on board. And again, we'll see. We'll see. Time will tell. What I can tell you, that's just my opinion. What I can tell you, this is fact. We're looking at a chart. I'm not making this up. Now let's go back. Let's just play this game here. Okay, remember, Apple was, until recently, NVIDIA is now the king. It's the king of AI. It's the hype stock du jour. But look at this. Let's play this game here. Apple, 1, 2, 3 peaks. Let's go back in time here. This one here, this was, I got to get right on there. Remember, this is Apple in red. September of 2020, we had a surge there. Right here was January of 2013, and all the way back here, July 2007. So let's look at that. Let's start here. July 2007. Again, this is what NVIDIA looks like today. That huge interest in Apple. July of 07. Let's see what happened back then. Type in AAPL. We'll go to weekly chart. Turn off all our lines just to play with that. July of 2007. So all the way back here. Hopefully you can see it. And 2007 July was right here then. So Apple, from that point, this is when everybody wanted to buy. They didn't want to buy it back here when it went up, 2,200. They wanted to buy it after it went up 2,200%, right into this July peak. And immediately it had a correction, went up just a little bit more, about relatively 20%. And then I'm going to measure from the high. Again, this is a weekly chart. It doesn't look like much. So that's when everybody wanted to buy. There was a huge interest. Google Trends confirms that. When you're looking online for something, you don't do a web search, you do a Google search, is what they call it. Just like you don't put a, adhesive strip on your cut, you put a Band-Aid on. Band-Aid's just a product name. And that's but everybody uses Google. That's why they say Google it. And so that's why Google Trends is so accurate. 60% drop from there. And then what was that other one? That was 2000 and January of 2013. There was a surge in searches on Apple. January of 2013. Zoom in a little bit here. And that was right there. And the stock still fell. So far we don't have any positive news. This one here, or positive follow-up through there. This one here, that would have been right after COVID, right? Let's see, September of 2020. And we go here. And we've got September of 2020 right there. This is it. And those that stepped in and bought that, because there was obviously there was a buying climax on the chart. See, everyone, they didn't want to buy it here. They didn't want to buy it here. They started to want to buy it right here. That's when they all became interested. And that was, again, a kiss of death, the huge interest. And that's, again, that buying climaxing. That's how those sentiment surveys work. The stock fell. That's 4 weekly candles. I wasn't even at the top. Now I've got the top. That's the stock fell 25% within less than 1 month after that surge. So there it is, guys. I think that speaks for itself. That's why I didn't want to do one chart. You can go back in time and you can do the same thing with Microsoft. Think back to any hyped stocks and you want to look at that. So there's why I'm making the case. Now, the thing about a bubble, and I learned this, and fortunately, I wasn't even shorting stocks in 2000. I was a stockbroker, only going long for myself, long for my clients. But what we learned in 1999, leading up to the bubble popped in March of 2000, is don't ever underestimate how high a bubble can go. So just because NVIDIA's up here now, you'll see this taper off when the stock breaks down. And I already gave you an update on the stock today, so I'm not going to spend any time there. Finally, we'll leave the video here, is talking about, differentiating everything I just showed you. Very poor market internals, evidence of a likely bubble in NVIDIA, and the fact that when you look at Apple, which is nobody cares about it now and it's already peaked, NVIDIA will most likely make or break this rally going forward. And you already know the levels to watch because I gave you that earlier today. And let's just leave it here with this. This is a quick synopsis to speak about positioning and performance versus all this rhetoric about, oh my God, you're bullish, the market's going up, this and that. And this is all on the site. We came in, let's go back a few years here. 2021, this is when the NASDAQ peaked back here just before the S&P. The S&P peaked right in the beginning of 2022, right there. And the NASDAQ effectively double top. We had a sell signal there. We came in short. In early January, I laid out my bear market targets. The third, I think, of which on QQQ, NVIDIA hitting the final target, or one of the main targets, I should say, to the button, going down 70%. So I'm just kind of summarizing for the year. But now within the year, there were a lot of other trades. We were short there coming into 2022, swing trend short. We reversed both of those trades. All of them were reversed at those 2 big bear market rallies. And this is 2023. And then we came into the year covering all shorts there right on the beginning. Again, right in the beginning of the year. It's on the site. Clearly said all shorts closed, going long, overweighting big tech. Long, my favorite stocks are Amazon and Apple, my 2 top picks, and overweight the FANGs. And so now, admittedly, did I hold those all the way? No. But we hit a lot of initial targets. The point is, came in short to that year, long into that year. We had swing shorts along the way. I've been looking for and thinking, and still do, that one of these final turns will be the one that takes us down, but I'm not going to position for it. Right now, we're waiting for the yellow lines to go. Oh, sorry. We also came into the year, we had sell signals, if you recall, official trades at the end of December in QQQ. Turn off all the lines here. I'm just trying to recap the last few years for you. This right here, we shorted right there with impunity, right on that. I had a trend line there. We got a sell signal there and posted covering that and reversing and going long. So for those naysayers that, there was your long opportunity. Now, I didn't personally, and we hit my max target. I'll get to that. Here it is, QQQ max target hit. So this is the setup. Again, we covered the shorts right off the lows, and QQQ was a long at 400. That was January 3rd. And max target up there, 409.41, which was hit. And that was, again, did I call it to the highs? No. But again, that was coming into the year short when we were heading down, reversing immediately 3 days into the year as a long. So the point I'm trying to make is this is swing trading. I will swing trade till the cows come home. Even if I'm talking, I might be talking a year from now, the most bullish long-term target on the Qs you've ever seen, but I may be at the same time not long because I need those buy signals to come. So hopefully that makes sense. If you want to vent and talk about, these horrible market calls, that's the macro. Those are the big pictures there coming into each year, which happen to be major inflection points. Ironically, I don't know the timing of it. It's just when the chart said go long, go short. And right now, again, waiting patiently without these next sell signals. And that's going to be, again, simplistically break below 433. And again, more close up today. I gave you the 60-minute chart of NQ. Let's see right here, 15-minute chart. My apologies. There's a 60. And this was the last trade I posted in the comment section shortly after that post went out this morning. And it's simple. This is, again, we're zoomed in, but this is the top of that trading range. And so the case was made not for a trend line break, although you could probably add one now. I think at this point I could have, I could have done that. Maybe we didn't have it. Yeah, we did. And now we're below it. So there's a little wedge, and it's nothing much so far, but it's a profitable trade. And I made very clear in those notes in the comment section for this morning with this chart, this is a trade for two people, two types of trade. An active trader that's just looking to game over near term oversold. Remember, we're overbought. We're at 86. We hit 86 on the RSI. Then we put in the divergence. Quick pullback. You can see, obviously, I'll give you another target right here. If you want an early target, I'm holding this one. The trades I put on this morning. But that's support right there. But I also said this can be a trade for a typical swing trader as well. Because although it's not a high probability short entry, you have an objective short entry at the top of a recent trading range, i.e. a rally into resistance with negative divergence. And then everything I just spent the last 45 plus minutes talking about, that gives it the potential to be the one. And so how do you trade that? How do you manage it? Well, stops not too far, but stops always commensurate with your price target. If you only wanted this little, what is that? The pullback so far, it's a 0.62%, 0.6% drop. If that's all you were looking for, you should have had a 0.3 or so percent stop above your entry right there. But if you're looking for, even as an active trader, a little bit more, again, stops should be commensurate with your own price target. But that's it. And as I said in that post, in that comment, take it or leave it. I really don't care. I don't profit from your trades when you make winners. And I don't certainly share in your losses. I feel for you, but you've got to decide what to trade. And then at the end of the day, also, one thing I'll bring up is on that, how I came into the years. When you look at completed trades, just this year alone, we've had, coming off to mind right now, and this is what I don't hear about from those same folks. And then we do this day in, day out, year in, year out. Natural gas, roughly 20%. We hit that. So far, we've swung it up to T2, at which point we had divergences. You might want to consider booking profits or raising your stops on it. That was it. We were in here at the low, 20% run, roughly up to 18 T2 to the button. We did the same thing this year, just even more recently with GDX. Gave that to you on the daily. Silver and gold miners, swung those up. And that was also roughly a 20%, 15, 16, 17%. Silver, we did it with IEP, was a 20% run up to T2. We're in here. These are all this year alone. So where am I going? Somebody said something about how the market's up this year. Let's look at QQQ year to date. Year to date, remembering that we came in short, but we went long right here. So we gamed a good part of that bounce. We were long. So, and then, yes, I did think that the end of that run would be likely that we'd go down and start the next leg down, and we didn't. But from there, I forget exactly. I think that target was, oh gosh, I just showed it to you, the final target. We're up a whopping 7% year to date. So even if you're a swing or trend trader and you followed this, you profited coming into the year, booked that quick 5-6% drop, turned around, gained a 5-6% upside bounce. They're plus 12 on that, and then you're down 7. But then if you took, if you're diversifying, not to mention TLT, we were long off the lows on that, but that was the end of last year. Oh, and then we shorted that from the highs right there. We hit that, and I gave you 2 pullback targets. So we went long, milked almost every penny of the run on the upside. It was here on this one here. Then we shorted it back down to T1 zone, and that was this year. So, guys, all I'm trying to say is for those that keep criticizing these market calls and looking at the bigger picture, I haven't from not one of you have heard, oh, thanks, man, caught nat gas, caught gold, silver, caught, you know, this stock or that stock. If you're only trading the stock market and you're only focusing on my long-term outlook in your positioning for that, then you're not getting value out of this site. If you're actively trading, we've had some great active trade setups, including the one put on today so far. Again, 0.5%. Do that over and over. I talked about it yesterday. You get 1%, 0.5%. You do it just once a week. You're going to blow the market away. You're going to have, if you do it only once a week, it's 50% plus return. So that's what I do. That's what this site's about. So please stop either confusing or trying to, spin a long-term outlook that's contingent on certain criteria, i.e. breaks of key support level sell signals to increase those odds. I still think the odds are very good now. They're favorable, or I wouldn't be talking about it for so long. Just my picture, my outlook is based on, my long-term outlook is based on long-term charts that go back like this QQQ monthly chart. And when you're trading on the monthly chart and you're going for the big trends here, that was actually more than 22. And this indicates to me where we're going to be, not next week, maybe even next month, but where we're going to be next year, maybe later this year, where we're going to be 2 years from now, 3 years from now. And that it strongly indicates on everything that I'm seeing right now, a lot lower, including mounting evidence of a bubble in AI and things like that, and narrow market breadth, everything I just covered in this video. And so when you see, I think, the king break on NVIDIA, I'm calling it the king of AI, I think it would be safe to say the market will have broken. And like I told you today, we still have that bearish engulfing. Sure, we're getting close to it. We're not above it yet. 840 goes. That's going to increase the probability that a top is in. I'm going to give you a number, not super high, but obviously my yellow line increases it a lot more. And then the purple line is kind of the knife in the back of NVIDIA, in my opinion. That's the primary bull market uptrend line off the October 2022 lows. And when that goes, especially at the 200 days, and remember, these same purple lines, I kind of repeated over and over, where not only was I as repetitive back then as I am now, that these yellow lines have to go, saying that long-term scenario outlying will not happen, cannot happen until these levels go. And if and when they go, there's going to be a sharp increase in the probability it will happen. And then I went so far as to say, when we hit them the last time, we were hitting 200 days, we had divergences, and I said, cover all shorts, go long. That's what was posted on the site, and that's what happened. That was the catalyst for this rally. It was that those key levels are defended. So these are the yellow lines and QQQ and everything will increase the odds of the next tradable correction, call it 8, 10%, whatever my QQQ targets were. And then the purple lines, which we're not even talking much about now because they're so far below, that will increase the odds of a much bigger. These are your correction targets. But again, these don't come into play and haven't come into play yet, as I said when I posted them yesterday or the day before, until and unless 433 gets taken out, right? So although I did, not to be confusing, I did mention an objective short here today at the high, swing it back down to the channel. It just gives you a more favorable entry if it does play out. That's going to be a drop of, let me move this one. We got a drop about 3.5%, almost 4% just to get there. And then if we trigger that, then that would be where, again, on a swing or trend position, I would increase to a full short position. Right now, with the Fed, everything we had, there was no reason, and no sell signals on the most important levels, no reason to be overly aggressive short. Done. Video's 1 hour. I knew it wouldn't stay short, but I wanted to get all that stuff in. Like I said, I see a lot of excitement around the post-Fed, what I call noise, even, dismissive. Oh, yeah, I've always said that, for years, the post-Fed noise, and don't read too much into it. And the initial reaction quite often isn't the one that sticks. That doesn't guarantee it won't be. It's just, as I said, quite often it is not. And so take it for what it's worth, guys. All right, I will wrap it up here, get the video out too. It will be my last one of the day. I've got some things I want to knock off tomorrow. I know I've got a lot coming. I've got A lot going on, couple appointments. They are at the home, but two different things. Got workers coming, and I'm going to be preoccupied through into the afternoon. Do my best to get anything important out to you. But there are, like I always do, the levels are there in advance. Nothing now big happens unless 433 is taken out. If we go up and pop above the channel, if we do it and do it soon and it keeps going, yeah, you're going to have an important development on the bullish side. You're going to have this divergence taken out. By taken out, it means we go above the previous highs. Right now we have downtrend lines, lower lows on the indicators, and higher highs on price. So we can afford one more thrust up, marginal new high, but not much more than that. Then it becomes hard on a 60-minute chart to make a strong case to be short or to add to new shorts. I like my divergent highs and lows for swing and trend trading on the 60-minute chart. Still have them right now, but like I said, can't go up much higher than that. Okay, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.